INOX. Let's get to PVR INOX. Reported their Q3 numbers. The revenues were slightly below street expectation. Revenue growth came in at about 11%. Margins, though, missed the street expectation. There was a sharp rise in movie production and distribution costs. We have with us Ajay Bijli, Managing Director, and Gaurav Sharma, the CFO of the company, joining in. Thank you very much for joining in. Mr. Bijli, 11% growth so far in Q3. What about Q4? Because we've got some big ticket releases coming through. What can you guide the market in terms of Q4 and even the pipeline, at least for the first half of FY26?
Well, we've got a big Salman Khan movie coming. We've got some English movies coming. Hollywood had suffered in the first 6 months because we did not have, the strike, impact of the strike, screenwriter strike was still there. But from third quarter onwards, Hollywood is back. So we are, excited about that. Captain America is coming. Two very big, there's a big Chhawa, which is a big, Vicky Kaushal movie, which is coming. And there is this Superman, Mission Impossible. That's next year, first quarter. So I'll just talk about Hollywood first. And from this quarter, which is coming up just now, we've got this Ajit Kumar movie, which is a Tamil movie, which is coming. Thandel is coming, which is a Naga Chaitanya and Sai Pallavi movie. So I think the momentum that we are always looking for in our business is building up, which is most important. So whether it was Pushpa, whether it was a Sky Force, all these movies created that momentum. Even the re-releases have created a momentum. And that is what we've been looking for. And so exciting times ahead.
Do you think the pipeline, sir, for Q4 is looking better than what we had in Q3, which sets you up for a better performance in the March quarter? And even the contribution of regional this time and the re-releases, because that's doing well. What was the contribution in the current quarter?
No, I won't say Q4 has got a better pipeline than Q3, but it's just that it's Q4 is the way every year Q4 is. But yes, we have some big movies and sometimes, surprises do crop up, as I said. So it's a decent enough pipeline. It's an exciting pipeline.
Ajay, hi. Occupancy around 25%, is it, in Q3?
Yes.
So I want to sort of talk about that because the content pipeline has been looking good. Third quarter as well, it was lots of new releases, plus the re-releases like you mentioned. Do you see that number itself, that occupancy number, pushing higher, or is 25% like the steady state new normal, so to speak, post-COVID normal?
No, this year, in fact, we had the weakest movie pipeline. So in fact, I don't think occupancies will remain here because next year, Hollywood is bouncing back. Hindi movies, there was not a single Khan movie, so to speak, this year. We did not have any Shah Rukh movie, any Aamir movie, any Salman movie. Salman movie is coming literally at the fag end of the financial year, 28th of March. We did not have any Hrithik movie, any Ranveer movie, any Ranbir movie. Ranveer only came in an ensemble movie, Singham. So given that and the Hollywood pipeline not being very strong, this was not a very good year as far as content is concerned. All that is going to change in 25, 26, where all the people that I mentioned just now, their movies are coming. So I'm expecting that to result in better occupancies next year, for sure.
Okay, fair enough. So, the content pipeline is, something that you don't entirely control. Let's talk about your controllables because they're looking better. Whether it is the average ticket cost or the F&B spends, they've all been ticking higher, right? What can you guide on this? Is there elbow room to maybe increase ticket pricing in Q4 and rolling into the new year? And also on F&B, because that's an area on which you folks have been really focused on to drive up more revenue from there. And there was some talk, I remember a couple of quarters back, we also discussed maybe a new foray, which could be, going beyond the obvious F&B at the cinema theater, at the movie theater, maybe sort of distribution at home, etc., in malls. So where are you on that plan?
Well, I think that with 159 or 150 odd million people coming to the cinemas, having a footprint of 15 million square feet, and having a good connect with the consumer on our brand equity, we want to pivot the company to three different verticals. One is, of course, cinema business, exhibition business, which we are focusing on reducing our costs, trying to get people in through various innovations that we do. On the other hand, we want to look at F&B beyond post-ticketed F&B. So the JV with Devyani to do food courts, a tie-up with Zomato for home delivery, 4700 BC, taking some of our own brands which are inside, pre-ticketed to post-ticketed to pre-ticketed. So also food is going to be a very big play. And third is a fun component, 3 Fs as I call it. And that is like what we've done with the candlelight screening we just now had, where we were showing live musical performances. We showed the Taylor Swift concert, BTS. We're talking to various people who are coming and watching events in the stadiums. If you can get digital rights, theatrical rights of that. I think the fun element, repurposing certain cinemas of ours and having some more activities, more engaging activities over there as well. So I think the three pillars on which PVR is going to pivot is going to be food, fun, and film, and not just be on content.
No, absolutely. Ajay, exactly. Gaurav, if I could come to you, just put some numbers on it. Exactly what Ajay was describing on both on the ticket pricing, whether you see further headroom. I mean, can you touch, say, go up to 300 or so in Q4, and also the food piece that Ajay described in detail, including the tie-up with Devyani. How much can we expect food to contribute, say, in FY26?
Sure. I think if you look at the growth in our ticket pricing year on year, we have delivered almost 4% growth despite of lack of, Hollywood films and big mega blockbusters from Bollywood. There's been a growth in ticket pricing. I think going forward with a very strong lineup from Hollywood, which are typically, focused towards urban family audiences, etc. We feel that there is definitely headroom for growth on ticket pricing. F&B is concerned, I think F&B continues to be one of the focus area for us. Our growth in F&B revenues year on year has been almost 9%, which is faster than the growth in box office. We've been carrying out a lot of initiatives on F&B, as Ajay was explaining. We've opened the first food court in the month of December in the joint venture company with Devyani. And there is a full plan for the next 12 months to open more food courts. I think we are focused on growing F&B at a fast pace, and there is definitely headroom available for further growth on SPH and F&B.
Hi, gentlemen. Good to see you and Ajay as well as Gaurav. Give me two numbers. The ad spend seems to have recovered at the highest we've seen the last few quarters. Do you expect the momentum to continue out here? And the second part is the net debt number. That's come down, I think, by a close to around 18%. It's clocks at around 1,000 crores. Further room to reduce both these two. And gentlemen, I want some numbers. So please help me out with that.
Well, ad sales, we're very happy with it. I mean, still there are lots of advertisers and sponsors who still feel that the uninterrupted, undistracted viewing of ads that comes on the big screen is unmatched. That people are coming back to the cinemas, and which is the reason why they're happy to. So ads will remain, ad income will remain the way it is, or in fact may become even better. I don't have exact numbers I can't give you, but we're very happy with the results that we've got this quarter, and we see this continuing. As far as net debt is concerned, of course, Gaurav can answer that, but I just want to make one point over here is that we've gone into a capital light model. A lot of our cinemas, 100 screens we have signed now already, in which is a FOCO model, which is franchise owned but company operated. The way hospitality industry does it, and a lot of retail companies have done it. We already have a lot of capital that we've deployed in the business, and we believe this is the time now for us to monetize on the brand equity that we've been able to build with the developers, with the retail community, and with the consumers. And there's no reason why if hospitality companies can do it, why can't PVR INOX also work on a model where other people are spending and we manage cinemas for them. So the asset light model and the FOCO model has also reduced our capital intensity, and that's why you see a net debt reduction also happening.
Just a quick word on the margins.
I think Gaurav wants to come in as well and add to that point. Yeah, Gaurav, go ahead, and then Reema wants to know about the margins.
No, I think Mr. Bijli has summarized it well. Nothing incremental other than the fact that we are very focused towards our capital allocation strategy as we pivot more towards asset light. We are pretty hopeful that the net debt will further come down. bringing down leverage in our business is one of the key priorities for the management going forward as well.
There appears to be higher movie production and distribution costs, which sort of are keeping your margins capped. What is the outlook on margins? Have you seen a spike in your production distribution costs? Is that a worrying trend? And again, just one follow-up on this FOCO, the number of screens that you will add. What is the guidance for FY26 in terms of screen additions?
So as Mr. Bijli said, we have signed up about 100 screens under the asset-light model, and these screens will come up over the course of next 2 to 3 years. As far as the next year financial year guidance is concerned, I think majority of our new screen openings will be in the asset-light model. Without getting into specifics, it will be more than 50% new screen additions under asset-light. So yeah, I think those are the numbers.
And on margins?
On margins, I think, to your point on film distribution, in fact, film distribution revenues have multiplied almost 2.5 times compared to last year. We were the distributors, PVR INOX Pictures, our subsidiary company was a distributor for Singham again in Q3, which did exceedingly well, collecting more than 300 crores. And there was therefore an increase in revenues and a corresponding increase in costs as well. Typically, distribution business, EBITDA margins are slightly lower than exhibition business, as a result of which there is a slight impact on margins, but overall contribution to profitability has been incremental.
Okay, all right, gentlemen. Appreciate you joining in and giving us that take. Thanks, Gaurav, as well as Ajay, for joining in. And as you all said, things will improve from here on. Off to the movies. Let's see how we see that recovery play out for this quarter and the coming quarters as well. Thanks for